The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. It's Christmas Eve. I'm Karen Cho with Sylvia Amaro. These are your headlines. European equities are little moved in thin trade as investors take a break and Santa takes off. The Stoxx 600 on track for its best trading year since 2021.
Investors pare back rate cut bets after a hotter than expected GDP print, while tech stocks push the S&P 500 to another fresh record close. And BP shares outperform as the energy giant agrees to sell a majority stake in its Castrol lubricants business to investment company Stonepeak for $6 billion. Hello everyone, welcome back to the show. Let's get a fresh look at how Europe is moving this morning. Worth keeping in mind that it is a thin trading day. It is Christmas Eve after all, so a couple of bourses are closed for trade across the European continent. But on top of that, the ones that are trading will be moving on a half day as well. So overall, thin volumes in Europe as well. But at this stage, we're actually looking at a mixed picture across the various European bourses that are indeed trading. But let me take you to Wall Street and show you how US futures are faring as well. It is also a shorter trading day for Wall Street, but at this hour, futures indicating a slightly negative start to the trading day. Worth keeping in mind, of course, that the questions around whether we're going to get a center rally are still out there. Yesterday, we did see a little bit of optimism when it came to the S&P 500. It hit a fresh record close during the session. But ultimately, Karen, we are struggling to see any sort of massive lift here for equities and see that center rally taking off.
You expect a little bit of decorating on top when it comes to a Santa Claus rally. The S&P 500, it's good enough after what has been a fairly decent year, but a little bit more maybe into year end. But in terms of the biggest movement we're tracking at this hour, it's Santa Claus. He's filled up the sleigh and he's taken off, apparently, about to hit some of the first destinations in the world that was the Christmas Day. So he is on the move. Let's hope you've been nice, not naughty this year.
Let's see what will happen later. When do you open Christmas gifts, actually?
Usually once I've got the turkey on.
All
I need to call the other side of the world, Australia, obviously a few hours ahead, several hours ahead. So it's a very time-limited window and I had to get the turkey on. So usually it becomes mid-morning. How about you?
For me and my family, the tradition is Christmas Eve evening.
Oh,
so you
brilliant.
do the dinner, you enjoy your dinner, and then you wait for midnight
Yes.
to open your gifts and see how lucky you were this year.
So there is some waiting.
There is some waiting, yes.
Yes.
But of course, the kids never enjoy that waiting, do they?
We tend to have a go to bed early sort of a
I like that.
scene setting because Santa Claus, you don't know what time he's going to turn up. I mean, we don't know his
That's
schedule.
it.
So if you're not in
Exactly.
bed, presents don't arrive.
That's it.
Well, speaking of presents, we saw it around the data yesterday. The US economy growing at its fastest pace in 2 years in the third quarter, coming in at 4.3%, an entire percentage point higher than forecast and up from 3.8% in the second quarter. Growth was boosted by robust consumer spending, which rose 3.5%, the most so far this year, as well as a notable rebound in exports. Kevin Hassett, director of the National Economic Council and the frontrunner to be the next Fed chair, touted the figure as a sign Trump's trade agenda is working.
It's really a fantastic number, and it's a great Christmas present for the American people. And, I would say that the headline for me is two things. That I think the big macro trends that we're seeing in these numbers are, first of all, that President Trump's trade agenda is working. And so we got about 1.5% of the growth on 4.3 because we reduced the trade deficit.
The strong third quarter GDP print saw investors pare back bets on rate cuts next year, at least until a new chair takes over in the summer. According to the CME Fed Watch tool, a majority of investors now expect the Fed to remain on hold until April. US President Donald Trump took the strong growth figures as a chance to warn the Fed, saying any Fed chair should not see the growth as an inflationary concern and should continue to cut, declaring, quote, "I want my new Fed chairman to lower interest rates if the market is doing well, not destroy the market."
And staying with some of the data stateside, US consumer confidence has fallen for the 5th straight month, now tied on the longest downward streak since 2008. The index dropped to 89.1%, for the month of December. That's down from 92.9 the previous month. So consumers cited a slowing labor market as well as concerns over high prices as well in that context. Michael Brown, the U.S. economist at Visa, believes there are underlying cross-currents that are causing a divergence in the data.
I describe it less as a high-low, but there's certainly a lot of bifurcation going on in the consumer spending story. Just look at the Atlanta Fed wage tracker data as an example. Bottom 25% of income earning households, they're still seeing positive wage growth, but it's nowhere near where it was, say, just 12 months ago. And I think these underlying cross currents are certainly creating this divergence, not just in income, but also in the resulting spend behavior that we're seeing across the income spectrum.
And Sean Raitata, senior economist at Vanguard, is joining us this morning. Great to have you in the studio with us on Christmas Eve. I'll start by getting your thoughts on how are you reading the U.S. economic data at this point?
We just had a very good print, didn't we, on GDP data. And I think a large part of that is because of the large-scale investment build-out related to AI and data centers, etc. And that's actually a central theme to our outlook for 2026 as well. We forecast US growth of 2.25% next year, a large part of that driven by the investment impulse from AI infrastructure and also the fiscal thrust from the One Big Beautiful Bill Act.
But what about perhaps the implications here in the shorter term? Because there's a school of thought suggesting that, for instance, the fourth quarter reading will be impacted inevitably by the government shutdown. Are you concerned at all about how that might impact the outlook for 2026 as well, whether that downward sentiment will actually push the overall picture a little lower?
We have conviction that the market will look through that. I mean, we know it's a temporary measure. There may be some drag from the government shutdown, especially in the Q4 data, as you say. But the market is forward-looking. We expect that investment, especially, will continue to be growing at quite a fast pace over the course of next year, and that should really provide a strong support for activity in 2026.
As you talk about one of the key risks, you point out that AI optimism collapses and investment build-out stalls. That is one of the potential scenarios. Is that possible when we talk about a build-out from some of the companies with the deepest pockets on the planet?
Yeah, I mean, the title of our outlook next year is Economic Upside, but Stock Market Downside. And that's really talking to that double-edged sword that you talk about. So this CapEx build-out is going to be a good thing, right, longer term, because it allows AI to diffuse into the economy. It lays the infrastructure and the tools that is there. But clearly there are risks to that view, particularly with the US equity market. You're right to say that a lot of these companies do have very strong balance sheets, and they're funding a lot of these things through free cash flow. But at the same time, markets are pricing for perfection, right? You're expecting 10 to 15% earnings growth over the course of the next few years, and there's little margin of safety then. So that's why we think there's a bit of caution that needs to be had there. The
credit environment can make a difference, and we just mentioned some comments from Donald Trump, from the president, talking about the fact that he still wants further interest rate cuts. And if I look at your policy rate expectations for next year, really just one cut from the US Federal Reserve. Do you think that's likely, that we only see one reduction next year?
Yeah, we're a bit more hawkish than I think what market's pricing at the moment, but part of that is because we think there's going to be quite a strong demand impulse, again from that AI-related investment impulse, but also fiscal policy. And with inflation, we think inflation is only going to end the year at 2.6%, still elevated and above the inflation target. That's the end of 2026. And so we don't think there's much space for the Fed to actually cut rates much next year. So we only have one cut penciled in, as you say.
But what about the cracks that we're seeing already? I mean, the data yesterday from the third quarter revealed that under the surface there may be issues, and one being the consumer trying to front load some of the purchases because they're worried about the impact of tariffs coming into year end. So concerned about further price hikes from here, the unemployment we're seeing at the youth end of the market, the lack of jobs being created, even though we're talking about an economic expansion. Does any of that start to bite in 26?
Yes, I think clearly the labour market, I think we're going to a new paradigm at the moment where supply is massively shifted downwards because of the range of policies being announced there, but also demand at a break-even rate is also going to be much lower. But back to the consumer, I mean, what we think here is actually the consumer, especially the kind of higher income part of the distribution, which drives a lot of this consumption, is in a very healthy place. Wealth has grown so much over the past few years, whether it's been the stock market, as you touched upon, the S&P now at the record high again, and also housing wealth has also increased significantly over the past few years, that there's still a lot of resilience and a lot of buffer there, even if you get a slight weakness in the higher frequency data.
So can I just double check on that point, whether you are seeing actually foundations for this argument around an affordability crisis in the United States?
Well, I think with inflation coming down, that is going to be very helpful for real disposable incomes. And there is this idea, the K-shaped economy, where you're having different parts of the income spectrum being able to deal with this in different ways. And I think that will probably continue. But in the main, if the large part of the consumption is driven by the higher income households who have that buffer, then we don't see any reason that will materially soften into next year.
So what does that mean in terms of a portfolio position then? When you think about the distribution here between equities and fixed income, what is the approach as you're thinking about 2026?
Yeah, so I think there's probably three reasons to be relatively cautious on the outlook for US equities, not just 2026, but over the medium to long term. And I think that's, one, markets are expecting quite high profit growth over the foreseeable future. And, there's big question marks here about whether AI will deliver and whether all this investment will generate that profit growth, or if we can actually build fast enough. There might be bottlenecks when it comes to energy supply or power generation, etc. The second is there's concentration risk here. These investments are only driven by just a few big players. And we know from the past that markets are pricing that every single big company, all of the Mag 7 are going to be winners into the future. But we know that doesn't happen in a creative destruction process. We know that if you look at the likes of Intel, Nokia, Cisco, these were the leaders in the early 2000s or the late 90s. They weren't the leaders in the end, and it turns out little known companies like Google and Amazon became the big giants going forward. So are we going to get that creative destruction process again? Probably. Will that create volatility? Almost certainly.
Can I test that theory? Because as you talk about Intel and whether its day is done, some of us had that question mark earlier in the year. Then the Trump administration swooped in, provided some assistance for Intel, opened another door and effectively found its way back into some sort of AI future. Isn't that what's different this time around? You've got a Trump administration, a US president, that will not allow big titans of industry to become yesterday's news.
Potentially, but we also know that when big periods of technological change happen, often smaller players that are more unheard of at the moment can leverage the infrastructure being built by the big players at the moment and then become that superpower. I mean, Nvidia, who thought there'd be such a success even just 5 years ago? But then there's also another risk, which is also kind of building in the background, which is that a lot of these companies now are taking on more debt. There's a lot more leasing of assets. There's a lot more special purpose vehicles starting to come into formation. These are hidden risks. We don't know how big a problem this is going to be in the future, but if there maybe a recession hits, often this is when these hidden risks start to reveal itself.
Sean, you're staying with us. We're going to discuss the European economy and also the UK on the other side of this. So we'll come back to the conversation ahead on the show. Diverging central bank policies could create several arbitrage opportunities next year. We'll break down the outlook for the ECB and what it could mean for markets.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Welcome back to Squawk Box Europe. Now, the ECB is expected to keep rates steady at 2% next year, with a majority of committee members agreeing that rates are in a, quote, good place. The central bank's most recent round of economic projections actually herald an upgrade to its growth and inflation forecast, suggesting the bar to any further easing is high. Following the bank's December meeting, traders cemented this view, with the market now pricing any move from neutral as a hike rather than a cut, potentially at the end of 2026. So let's return to the conversation with Shanrai Dutta, senior economist at Vanguard. What do you make of this assessment in terms of what is the most likely move from the ECB next? A growing majority for a hike. Do you agree with that view?
Say it again. I think the ECB is in a good place, and I don't expect any move.
Quote of the ECB this year.
I don't expect any move anytime soon. But we actually have a slightly out of consensus view here, where we think the next move will be a cut more than a hike. We think the risk to the inflation outlook was skewed to the downside, and there's three reasons for that. One is that energy prices are going to fall significantly, especially in Germany in the early part of next year, which could weigh on inflation expectations if that persists. Wage growth is moderating and has come down quite significantly. And we also have that legacy of the 2010s period where core inflation just couldn't really get up above even 1.5%. Are we going back into that low inflation psychology world, and will that then drag rates lower over the medium term?
So on that point, do you think that the ECB perhaps has changed the way it feels about lower inflation? You know, what is the rate that the ECB will be happy to withstand in the new year if we see prices falling?
Well, I think the context of the last 3 years is we've had above target inflation, so they've had to be relatively hawkish and they've had to try and get that down. I think that's over now. They've achieved a soft landing. Right, whether it's through good luck or good policy, inflation is at 2% right now. But I think as you go into the early part of next year, you're going to get inflation below 2%. And we know from the context of the 2010s that Europe finds it very difficult to get inflation up, absent an exogenous shock like an energy crisis or COVID, to get inflation up through domestic demand pressures. So I think that is going to be the broader challenge, assuming you get no big supply side negative shock like we've had in the last few years.
It certainly is a contrarian view to be talking about a rate cut when Isabel Schnabel in recent weeks was talking about the next move being a rate hike for the ECB. And the scenario very much straying from the consensus. What do you make, though, of the services-led growth? Because we continue to see that one area of resilience in Europe continues to be the inflation on the services side.
Yeah, I mean, the two-speed economy, as people say, right? Services is doing pretty well, especially in the last few months. The PMI surveys have signaled a slight uptick, and manufacturing continues to be quite weak, especially in Germany. Now, we're hoping that some of that fiscal stimulus that comes through, particularly in Germany, starts to help with that. But clearly, manufacturing is in structural decline in Europe, and that isn't going to change anytime soon either. But one extra point on Isabel Schnabel and the ECB. I mean, we do know that over the next 18 months or so, there's going to be quite a lot of change within the governing council. And some of the hawks, including Isabel Schnabel, are going to roll off that committee and be replaced by others. And so you might get a slightly more dovish-leaning tint to the governing council as we look to this in the next year or two.
Now, that is fascinating, isn't it? Also some changes around emissions and the way the ECB was willing to treat the energy side around climate change. How significant are those technicalities too, where they've pushed out the time frame?
Yeah, that's right. So ETS2 is now going to probably come into 2028, not 2027. I don't think it's going to be too much of an impact because what it means is to just shift the, as you say, the technical inflation uplift into 2028. But markets tend to look through that, so I wouldn't be too...
But markets do, but does the ECB look through that if it's on the longer term forecast?
I think they will, because it'll wash out in base effects. As long as it doesn't affect inflation expectations, I think that should be fine.
I'd like to get your thoughts also in terms of the trade flows, because the Governing Council has been very vocal in the past about how they were concerned around an inflow of Chinese goods to their area. As you look at 2026, how are you looking at the trade relationship also from a monetary policy point of view?
I mean, as you say, this is another big disinflation risk, is that you get cheaper goods coming into Europe from China as they reroute their exports away from the United States. But I think that there's a more kind of fundamental problem here with an existential threat that comes from China and the US when it comes to Europe, is Europe is caught in between. Europe is lagging behind on the AI innovation cycle. US and China are clearly far ahead on that. And we know from the experience of really the 2000s, 2010s onwards, is productivity growth has massively lagged in Europe versus the US. And a large reason for that is because of a lack of business dynamism, maybe regulations a bit too strict, but also the influence of China, which has also then outcompeted us in a number of different areas when it comes to things like EVs or other broader industry.
Disinflation on goods coming in on the Chinese side, the currency impact as well. Euro has been up 14% this year versus the dollar. What does that mean in terms of going into next year? Because some of the council members, the governing council members, are wondering whether this was a one-off adjustment or whether you see further appreciation of the currency into next year because of the way investors are diversifying around capital allocation. That could have a further impact. Do you think the euro gain this year was a one-off, or is there more to come?
We're broadly neutral on the outlook for the euro versus the US dollar. We think a lot of that move has come already.
So a one-off adjustment in your view?
Exactly, it's a one-off adjustment. But it still will have the disinflation impact, will have its impact next year rather than this year because of the lags associated with stronger currencies, in particular contracts being fixed, etc.
When you think also about 2026, let's look at the UK for a moment, because it seems that it is perhaps the central bank that is in a little bit of a more of a difficult picture to some extent. Walk us through your expectations for the BOE.
So we expect the Bank of England to continue to ease fairly gradually. So we think maybe another couple of cuts next year, so we get to 3.25%, which is our estimate of neutral. Inflation is coming down slowly. The Chancellor's announcements that she made at the budget last month will help with that, particularly the direct impact on energy bills. That said, inflation expectations and wage growth are still relatively elevated, and so they need to be a bit more cautious and they can't go too quickly.
We were discussing earlier the political ramifications here also from an economic point of view. Do you look at that with some concern as well?
Yeah, and I think what was discussed earlier is true, that the local elections in May is going to be a big pinch point. And if we do get a significant swing away from Labour in that election, the big risk for markets, in my view, is that you get a new Prime Minister or a new Chancellor, or both, that maybe don't give too much credence to the current fiscal rules. And if that happens, we could be in a Liz Truss type situation again, where markets start to throw the toys out the pram.
It does feel as though there is somewhat of an air of discontent out there. But you think there's a lot of moaning, and that's not just the typical moaning. It does feel as though people feel the pressures, the cost of living crisis, all the extra taxes coming to bear, some of the council changes. It does feel as though there's an element of discontent.
Across the board, but I'm wondering whether there is actually a strong likelihood of seeing a change in leadership, or whether this is just speculation, because they do have a majority in Parliament. It's very normal to see the incumbent being punished in local elections as well. How much probability are you assessing to that scenario?
We don't have an exact probability, but the fact is Keir Starmer's approval ratings right now are low. Right, they're lower than Liz Truss was at that time, and so we can't rule it out that there will be a leadership change.
Can I ask you a little bit deeply too on the MPC, because what's still sticking with me on the back of last week is the line that Andrew Bailey took, which is that very little space now, less space to move on reductions in interest rates when you've already moved to this point. But we saw a couple of the hawks that had a very strong line in recent months starting to soften some of their commentary. Does that suggest that the bar is actually lower, not higher, as Andrew Bailey was suggesting?
I think that's right. I think a big part of the reason the hawks have softened is because of the announced policy measures from the Chancellor last month. They had to get through that event, but also the lower inflation profile driven by energy means that inflation expectations are less likely to become de-anchored. And that's what they were worried about. If you looked at the MPC minutes back in August, for example, the main risk they were concerned about were inflation expectations starting to move away from them, especially on the consumer side. If we remove that from the equation, then there's much more comfort in easing rates going forward.
Yeah, it felt as though the hawks were kicking and screaming towards a rate cut. Now that we've had the cuts and suggestion there's not that many more, feels like they've now come around. So interesting, isn't it, in terms of the terminology? Sian, thank you so much for joining us, and we do appreciate the effort to come into studio and see us on Christmas Eve. Sian Ratita with us, a senior economist at Vanguard. BP, in company news, has agreed to sell a majority stake in its Castrol lubricants business to investment company Stonepeak. Stonepeak will acquire a 65% stake in the business for $6 billion, valuing it at over $10 billion. The deal is a sign that BP's board is finally addressing the market's concerns, according to the CEO of BRI Wealth Management, Dan Boardman-Weston.
I think the deal this morning that for BP to sell a majority stake in Castrol is sensible. The market's not been happy with their strategy for some time, sort of pivoting towards green technologies in sort of 2020 ish. And I think with Meg O'Neill coming in, you're going to see that change. I think there'll be further stake sales of different parts of BP, and really getting back to their bread and butter of focusing on oil and gas exploration and development. So I think it's a step in the right direction. And I think the board is finally getting to grips with a number of the issues that have plagued BP for what seems like quite a long time now, at least sort of 2 or 3 years.
For more on BP's efforts to divest $20 billion of assets by the end of 2027, head to cnbc.com.